You see it now. This week, we are going to talk about long-term assets. Do you have any questions before we begin? Yes.
I have a question. So when I was doing your review, my thing was like when I was going through it, you don't know if you're like getting it right or not. So is there a way like?
So here's why I don't give the answers, because I don't know if you noticed, but a lot of the questions are just like the study guide. And so why I do that is if you work on the study guide and you get the right, if you get that, I get what you're saying is you don't know the right answer. And where it's difficult for me is I try to make the midterm just like the study guide. And what I encourage you guys to do is work as a group in the discussion. So if you have questions, you can get the answers right. If you guys have any suggestions for how I can do it different, would you like a midterm with the questions? And then that way I'd have to pretty much make the midterm study guide with the questions. If I do that, then I have to make the midterm totally different. Do you see what I'm trying to get at? It's a toughie. Feedback? Because I kind of, my goal is to make the midterm just like the study guide, but I can't give the answers. Feedback? Anybody? Come on. Someone's got to have an opinion. I know you do.
I like the way you did it.
It's just real hard. It's like you do it one way, people get upset with you. You do it another way. I really do want the feedback. The problem I have when I do a study guide and I give you all the answers, then people get upset because the study guide was nothing like the quiz, because I have to make the questions all different then. The purpose is to try to assess you, Anyway, moving on, guys, for Chapter 7. Long-term assets. Now, we've talked about, excuse me. We have talked a lot about physical assets, like buildings, like desks, electronics. Those are long-term assets if they have a useful life of greater than a year. We call physical assets tangible assets, such as land improvements, buildings, equipment, and even natural resources, natural gas. They all have what we call a physical substance. They're tangible. You can see them. Intangible assets are almost as valuable as physical assets, but the problem with intangibles is they lack a physical substance. Patents, trademarks, copyrights, franchises, and a new asset we're going to talk about called goodwill. Are any of you guys familiar with an intangible asset you could identify? Yes.
Patents?
What? A patent. What kind? What's an idea of a patent?
Isn't it like the right to be able to produce?
Exactly. Think of, you guys are all young, but Viagra. Do you know the money that Viagra made for the pharmaceutical, for Pfizer specifically? It made all men happy. So when they were 70 years old, they'd pop these pills and they were happy. Guess how much money Viagra brought into Pfizer? That exclusive right to produce a specific product. Okay? Right now, there are these weight loss drugs going out. Have you heard of those? So it's an injection. It's a diabetes type 2 type of drug. But I mean, the market's crazy because for 15 or 17 years, no one else can produce what they get to produce. Now, granted, they spend a lot of money coming up with the product in it. So that's the reason we do have patents, so they can reap some of their costs. But a patent is intangible. You can't see it, but the benefits are huge. It is a huge, valuable asset. Trademarks. How about the Target, the big red Target with the dot in the middle? Who else can use that sign? Nobody. So isn't it amazing we know what that means? Or guys, what about the apple with the bite cut out of it? Isn't that pretty amazing? The power that sign has. We all know we're talking about Apple, the electronics, correct? Franchises, the right to use a certain product, such as McDonald's. You know, oftentimes those franchises are so significant in that we know what to expect. And so therefore, we often go and drive through those restaurants that can be chains per se because we know what to expect. Make sense? We will talk about goodwill today. So here is a sheet of Walt Disney Company. And we see the current assets. Here you see the long-term assets, film and television costs, investments, parks, resorts, and other property, projects in process. Look at this, intangible assets net, and this goodwill that we're going to talk about is a large piece. 80 billion in terms of total assets of 193. So that's not quite 50, it's about 40% of the total assets is just goodwill. Okay? How do people acquire assets? Well, generally through purchasing. So we've got property, plant, and equipment. And we record these assets, property, plant, and equipment, at the original cost of the asset plus all costs necessary to get the asset ready for use. So we'll talk about what that means. Land, we show what we bought the land for, and then all expenditures to get the land ready for its intended use. It could include real estate commissions, back property taxes. So let's say you purchased this land from someone who had been negligent on paying their property taxes. In order for you to buy the land, you're going to have to pay those back property taxes. So that's an added cost to the land. Clearing the land, filling it, leveling it, cash received from selling salvage buildings material reduces the cost of the land. So if there's items on the land you're going to remove and you get paid for selling those items, that will help adjust the price of the land. So in this case, we purchased the land and the existing building for $500,000. We paid a commission to sales agents of $30,000. We paid unpaid property taxes of $6,000. We had to pay title insurance to ensure that the land was free and clear for $3,000. We removed the existing building, which cost $50,000 to remove, but we sold some of those materials and we received $5,000 from those materials that we sold. So do you see that's a net, a minus $5,000? We reduce what we received for those goods or those materials. We reduce it from the price of the land. And then we had to excavate the land for $6,000. So our total cost of this land, even though we bought it for $500,000, by the time we're ready to use it, it's going to cost us, the cost on our books is $590,000. back property taxes we add to the cost of the land. Current year property taxes, along with current year insurance, current year maintenance, are all period costs, so they get expensed in the current year. Any questions on this, guys? Students incorrectly can add or ignore the cash received from the sale of salvage materials. Don't forget to subtract that from the cost of the land. Cash received from the sale of salvage materials helps reduce the total cost of the land. Okay? Land improvements can include parking lots, sidewalks, driveways, landscaping, lighting systems, fences, and sprinklers. So land improvements are a whole nother category of long-term asset. So these are ideas. Think about this school. Think of the cost that went into those parking lots and the lights out there. That's an asset that gets used up over time, doesn't it? And it wears out. I mean, we all know lights wear out, the asphalt wears out, or if it's cement, I don't know what is out there. I think it's asphalt. They wear out, though, over time. So that's going to be depreciated. Land improvements have limited useful lives and are recorded separately from the land account. Okay? Buildings, administrative offices, retail stores, manufacturing facilities, and storage warehouses all are considered buildings. Buildings include the cost of getting a building ready for use, real estate commissions, legal fees, and remodeling costs all get added to the cost of the building. So what they're saying here, unique accounting issues arise when a firm constructs a building rather than purchasing it. So during the period in which the building is being constructed, the insurance, the mortgage interest, the utilities, all those costs that are incurred while the building is being built get added to the basis of the building, is what they're trying to say there. Equipment is machinery that's used in manufacturing, computers, and other office equipment, vehicles, furniture, and fixtures. You may add to that sales tax. You know when you purchase an asset, how oftentimes you have to pay sales tax on it? That gets added. If you have to ship the item to you and pay for the shipping, that gets added. If you're paying for someone to assemble the item, and any cost to prepare that asset for its intended use. Remember, recurring costs such as insurance, property taxes, and certain maintenance items get expensed each period. Okay? So changing oil in machines happens all the time. Okay? So that is an annual cost that will be expensed. There are things called improvements that could get added to the basis of the property. But no basic things like, when I think of an automobile, changing the oil, putting in the washing fluid. Those are annual maintenance expenses you have to do all the time. Okay? Those don't get added to the cost of the asset. Those get expensed in the current period. So here, let's say this piece of equipment, let's say this is a big commercial oven. The purchase price of $82,000 plus the sales tax, plus to transport it, the shipping insurance, and to pay for installation all get added to the cost of the asset. Annual insurance on this asset is expensed throughout the period. Okay? So if $1,600 was purchased as insurance for the whole year, we would add that as prepaid insurance, and then each month that insurance expires, we would write that off. Any questions? Oftentimes, companies purchase a group of assets that we call a basket purchase. You purchase more than one asset at the time for one purchase price. In order to determine how much each of the individual assets we're going to show as a cost, we need to allocate the total purchase price based on the relative fair values of the individual assets. So let's say Olive Garden purchases land, building, and equipment for $900,000. Okay? So they got $900,000 for all of it. But when they looked at the estimated fair values of the land, they said the land was $20,000. The building was $700,000 and the equipment was $100,000. So that totals $1 million, but they got it for $900,000. So do you see the way in which Olive Garden will determine the cost? They'll prorate it. If the land is 20% of the total, they'll take 20% of $900,000 and show the land's value that they paid for it at $180,000. Or the building, if the building was 70% of the total, they'll show the building asset to be $630,000, 70% of $900,000. Does that make sense? And then likewise with equipment, if that's 10% of the total, they'll take $90,000. Do you guys have any questions with that? Got it? Okay. What about this one? A company makes a basket purchase of land, buildings, and equipment with estimated fair values of $70,000, $150,000, and $30,000 respectively. The purchase price is $210,000. How much should be recorded to the land account? $58,800? How many agree? So we add the 70 plus the 150 plus the 30, totals 250. 70,000 divided by 250 is 28% of the total. So we'll take that purchase price of $210 times 28% to give us what will show the allocation for that land to be. Make sense? Yes, no? I have one person out there shaking their head. I'd like other feedback. Y'all getting it? Natural resources include oil, natural gas, timber, and salt. Now, around here we have a lot of salt and a lot of timber, don't we? My sister lives down in Louisiana, and they get a ton of oil and natural gas off of her land. I wish I had oil and natural gas. I have timber, but that's about it. But all of these are clearly benefits that last for over a year. They're distinguished from other assets since they get physically used up. So you can only take so much oil out of a specific plot of land. Okay? Or so much natural gas, timber, and salt. Right? These natural resources are recorded at cost, plus all costs necessary to get the natural resources ready for their intended use. So no, all of these tangible assets we've talked about, land improvements, building, equipment, and natural resources get recorded at cost, plus all costs necessary to get the asset ready for its intended use. Let's take a moment and look at McGraw-Hill, the homework. So, here, let me see if I can make this a little bigger. The Italian Bread Company purchased land as a factory site for $70,000. An old building on the property was demolished and construction began on a new building. Costs incurred during the first year are listed below. Determine the amounts that the company should record in the land account and in the building account. Okay? So I am just going to run to the restroom real quick and I'll be right back. But I want you guys to attempt this, okay? I'm so sorry.
Can you make it a little bit bigger?
Of course I can. You just can't see this piece, okay? But of course I can. Is that helpful?
Yeah.
I'll be right back. You guys ready? So the purchase price of the land was $70,000. Would that go under land or building? Land, $70,000. The demolition of the old building, $9,000. Would that go under land or building? Land. So a minus $9,000, right? Because, oh, excuse me. No. $9,000 costs. Sale of salvaged materials. Land, a minus 1,100. I got ahead of myself. Architect fees for the new building. Legal fees for title investigation of the land. Property taxes on the land for the first year. I don't think it should be either. Because for the first year, I believe that should be expensed. Building construction costs. Interest related to the construction. See what I'm doing here? So, actually they don't even show in here the property taxes for the first year on the land. Because remember, if you had to pay property taxes in arrears for previous years, you would add that to the cost of the land. But in each year, you're going to pay property taxes, so that gets expensed each year. Does that make sense? Okay? Okay, let's look at this one, guys. Great Harvest Bakery purchased bread ovens from the New Morning Bakery. New Morning Bakery was closing its bakery business and sold its 2-year-old ovens at a discount for $700,000. Great Harvest incurred and paid freight costs of $35,000, and its employees ran special electrical connections to the ovens at a cost of $5,000. Labor costs were $37,800. Unfortunately, one of the ovens was damaged during installation and repairs cost $4,000. Great Harvest then consumed $900 of bread dough in testing the ovens. It installed safety guards on the ovens at a cost of $1,500 and placed the machines in operation. Complete the following schedule to show the amount at which the ovens should be recorded in Great Harvest equipment account. Indicate where any amounts not included in the equipment account should be recorded. Okay? So, sorry I have to lower that. So, complete the following schedule to show the amounts at which the oven should be recorded in Great Harvest equipment. What do you guys think? Anyone? I'll start. How about purchasing them for $700,000? You think that's a good one? Purchase ovens. Purchase price $700,000. What's next? Freight costs. How much? $35,000. What's next? Electrical. 5. Labor. And that was $37,800. Repairing it. Oops, repairing costs. Or do they not want us to have repair costs? Repair for damages, 4,000. Testing it, the dough, don't you think? 900. Safety guards, 1,500. You think that's right? What don't they like? Okay, so the repairs for damage, that can be debatable, but we're being told the repairs is just to fix it to get it back to where it was supposed to be. So it's not as though, in this case, they are improving something or changing it. They're just trying to fix it to what was destroyed during the shipping. So we will add everything but the repairs here. The repairs we will show as an expense in the current period. Okay? Make sense? Yes? Okay. I'm not going to do that one yet. Okay. Let's go back to how we would go about recording intangible assets. When we purchase intangibles, we record them at their original cost plus all other costs necessary to get the asset ready for its intended use. Intangible assets, when they are purchased externally, that's how you handle it. When intangible assets are developed within the company, it's a whole different story. Intangible assets developed internally, most of the items you are going to expense in the income statement in the period in which we incur those costs. So any research and development to try to get these intangibles to its place are going to be expensed on the income statement. This just shows you the top brands. This is as of 2019. But Apple brand, the brand of Apple is one of the most popular brands in the world. Then comes Google, then Amazon. It's odd to me that Mercedes, McDonald's, and Disney are in here. Microsoft, I guess, but yeah, these three, wouldn't you agree, those are pretty powerful brands? Okay, so Apple, again, how many of you guys have an Apple product? It's kind of crazy, isn't it? How many of us have these phones or iPads or computers? Microsoft, Amazon. How many of you guys have purchased something from Amazon in the past month? Nick. Okay. I went through all those. Okay. Research and development costs are costs that are incurred to conduct research and to develop a new product or process. They are not reported as an intangible asset in the balance sheet. We record these expenses, research and development, in the income statement rather than as an intangible asset in the balance sheet. We expense them because of the difficulty in determining which portion of the research and development that benefits future periods. So because so much trial and error goes into various intangibles, they all get expensed. Okay? Okay? Got it? Advertising. It's difficult also to estimate which of the advertising is going to benefit future periods. So, it's all advertising will be expensed in the income statement. No, we record purchased intangibles as long-term assets at their purchase price plus the cost to get them ready for use. But we generally expense intangible assets that are developed internally. Those are for intangibles. Now, a patent is the exclusive right to manufacture a product or to use a process. I was wrong. I said 15 or 17. It's for 20 years. This ability to exclusively manufacture a product or use a specific process is granted for 20 years. When patents are purchased externally, you would capitalize or show as an asset the purchase price plus legal and filing fees. When it's developed internally, the only piece you're going to capitalize or treat as the asset are the legal and filing fees. All the research and development costs are only expensed. Make sense? Good? So, a company obtains 2 patents during the year. Patent 1 was purchased from another company for $200,000. Patent 2 was developed internally at a cost of $200,000. Both patents had legal and filing fees of $40,000 and $5,000 respectively. Okay? So, the patent 1 that was purchased externally is all going to be capitalized or treated. When I say the word capitalized, it means treated as an asset. Patent 2, how much of this will be treated as an asset versus expensed? $45,000 will be treated as an asset, and the $200,000 is going to be treated as research and development expenses, okay? Copyrights are the exclusive right of protection given to the creator of a published work. So this could be a book, a song, painting. Well, is a painting a copyright? I'll have to find that out. Exclusive right of protection given to the creator of a published work, granted for the life of the creator, plus an additional 70 years. This allows the holder to pursue legal action against anyone who attempts to infringe on that copyright. So do you ever hear, well, I've heard of different songwriters. They are trying to get sued by people saying they took a piece of the song. Do you see, this is why they are doing that. Or this is the defense they can go by, that they took someone else's work. Again, accounting is identical to that of patents. You're going to expense the research and development. You're going to capitalize the legal filing fees. Okay? Trademarks. Words, slogans, symbols that distinctly identify a company, product, or service. This is interesting with trademarks, guys. They are renewable for an indefinite number of 10-year periods. But those companies better make sure they file it within that 10 years or they lose it. Okay? Amazon's a popular one, Coca-Cola, Google. I mean, are there any on here you can think of? I mean, I'm always think of the Target. Under Armour is a good one. Anyone? Again, with trademarks, we will capitalize legal, registration, and design fees, but any advertising costs get expensed. Franchises, local outlets that pay for the exclusive right to use the franchisor's name and to sell its product within a specified geographical area. The franchisee records the initial fee as an intangible asset. Now, oftentimes the franchisee has to pay annual costs to the franchisor for selling the products. Those get expensed each year. The initial fee is amortized, okay? Capitalized, treated as an asset, and then amortized. Here's a huge intangible asset called goodwill. Goodwill is the portion of the purchase price that exceeds the fair value of identifiable net assets. This only gets recorded when one company acquires another company. Now, when we say net assets include the assets minus any liabilities that somebody is assuming. Most companies create goodwill to some extent through advertising, employee training, and other efforts. How those are generated internally and get expensed. But when you purchase another company and you pay more for that company than the value of the net identifiable assets, that excess amount is goodwill. Why would someone pay more for a company than what the company's assets are? They have a good reputation. They have a following. Right? It's worth it. Allied Foods acquires Ritz Produce by paying $36 million in cash. The fair value of Ritz's Produce's identifiable assets and liabilities are as follows. Their accounts receivable that the Allied's going to receive of $10 million, equipment of $32 million, a patent of $8 million, accounts payable, what they owe, of $9 million, long-term notes payable of $15. So if the total fair value of assets is $50 and the total fair value of liabilities is $24, wouldn't that mean their net assets are at $26,000? So if they buy it for $36, do you see how goodwill will be assumed of $10 million? Make sense? That is how we determine goodwill. What we would do is we would show the acquisition, we'd show the accounts receivable coming in at $10 million, the equipment at $32 million, the patent at $8 million. The goodwill will be $10 million, and the amount that we owe, the accounts payable we're assuming, and the long notes payable we're assuming, and the cash. That is how we would record it. Okay? Any questions, guys? How you doing? Remember, intangible assets have no physical substance and generally represent exclusive rights that provide benefits to owners. Common types include patents, copyrights, trademarks, franchises, and goodwill. Okay? Which of the following is an exclusive right to manufacture a product or to use a process? Now, once an asset's been purchased, then, depending on what type of cost it is, determines what we do with those costs after they've been purchased. If, over the life of a long-term asset, the owners often incur additional expenditures associated with the asset, we will either capitalize them or expense them. Okay? We will capitalize them if those costs are going to benefit future periods. However, we will expense them if the cost only benefits the current period. So, oil changes, repairs, tune-ups, that's just needed to keep an asset running. But if whatever we're doing, those costs can extend the life of the asset or give it more capabilities, we may capitalize it. So repairs and maintenance only benefit the current period, we'll expense them. But if these repairs and maintenance make major repairs that then will help future periods, we're going to capitalize it. If we add on components, then we capitalize them, or improvements. Incurring litigation costs to defend the legal right to an asset, we also would capitalize. Does that make sense? What is materiality? An item is said to be material if it is large enough to influence a decision. When an expenditure is not material, then generally that cost is going to be expensed, regardless of its expected benefit, which means it's small in amount. Companies generally have policies regarding amounts that are not material. Generally, they'll expense all costs under, say, $1,000, regardless of whether there's a future benefit or not, just because the cost is immaterial to the big picture. Okay? Which of the following costs would be expense, guys? Perfect, guys. So remember, we capitalize or treat as an asset expenditures that benefit future periods, and we expense those that only benefit the current period. Let's go back to our homework here, and I want you to take a minute. I'll make this as big as I can. So this just says, here, select whether health services would capitalize or expense each of the following expenditures related to the helicopter delivery operations in the current year. Okay? I'll give you a couple minutes. Who wants to take number 1? Overhauled the engine at a cost of $7,500. Health Services estimated the work would increase the service life for an additional 5 years. Capitalize. Next, cleaned, repacked, and sealed the bearings on a helicopter at a cost of $800. This repair is performed annually. Added new emergency health equipment to the helicopter for $25,000. Modified the helicopter to reduce cabin noise by installing new sound barrier technology at a cost of $15,000. Paid insurance on the helicopter for the first year, which increased 15% over the prior year to $9,000. Performed annual maintenance and repairs at a cost of $39,000. Excellent. Does this make sense to you guys, how you figure this? Okay, moving on. Depreciation and amortization. So even though these assets these items are assets, we still need to take a cost, a piece of the cost, which we call depreciation, on these assets. Know that the way we determine the word depreciation is different from how the dictionary defines it. The dictionary defines depreciation as a decrease in value. But that's not what we mean when we use depreciation. We use the term depreciation as allocating an asset's cost to expense over time. We're allocating a portion of the cost of the asset to be expensed over its useful life. So here we have an asset. This asset is going to provide us with 4 years of service. Say it's a coffee, a cappuccino maker. Okay? We purchase this asset and we anticipate it's going to allow us 4 years of use. Because we're buying this asset for $4,000, we're going to allocate a portion of its cost to depreciation over 4 years. Remember, this depreciation we're referring to talks about allocation of a portion of the asset's cost to an expense over the periods that are being benefited. Students sometimes think accounting depreciation is a decrease in the value. No, it's not a decrease in the value. It's an allocation of the asset's cost to be expensed over a period of time. Okay? So when a local Starbucks pays $1,200 for equipment, and we are going to depreciate it over 4 years, we will show that $1,200 divided by 4 years, or $300 we will show as depreciation expense each year. $300 we show as depreciation, and we treat a new account called accumulated depreciation will be this contra account that will be used to offset the asset. So in year 1, we'll show depreciation expense of $300 and credit our accumulated depreciation. So that depreciation expense is an expense on the income statement. The accumulated depreciation is a contra account on the balance sheet that will offset against the equipment. Do you see? So we will always know what we purchased the equipment for, but we show the accumulated depreciation, the amount we have taken in depreciation over its life. Okay? This is the asset. This accumulated depreciation is the contra asset account. Now, how do we determine how many years? We're going to look for an asset's service life. Guys, nothing's etched in stone. We estimate what we expect this asset, how long the asset's going to last us. So to compute depreciation, we need to know what we think its useful life is or service life, and we also need to know what we think its salvage value, or we call it residual value, will be. This residual value is the amount the company expects to receive from selling the asset at the end of its service life. So once the asset's used up, what's it worth? We usually do not depreciate that residual value. Then each company gets to determine which depreciation method they choose to use. And there's different methods that they may opt for. Often, the three methods that are used are called straight line, declining balance, and activity-based. Know that straight line and activity-based are very similar, and declining balance is a whole different animal, and I'll explain how they vary. Okay? Any questions so far? When we use straight line depreciation, we take into account what we purchased the truck for minus its residual value or salvage value. And that net amount is what will depreciate. So if the truck was purchased at $40,000, but the residual value at the end of its useful life is $5,000, then that means we'll depreciate $35,000 over, if it's straight line, we do it out by years, over 5 years. So $35,000 divided by 5 years means we'll depreciate $7,000 a year. Okay? Pretty straightforward, isn't it? So we would show in year 1, we'll take depreciation of $7,000. And now the new book value is at $33,000, but we're going to still take $7,000 every year until at the end of the useful life, after those 7 years, we show $5,000 on the books. Okay? If we started this on November 1st, see, in this way, we're just showing we purchased everything on January 1st. That doesn't happen, does it? So if we show on November 1st, we began depreciation, we need to take 2 months out of 12 months, or 1/6 of that $7,000. Right? So in that case, it's going to be $1,167 in the first year. Then we'll take our $7,000, but in year 6, you know, that portion of the year we didn't use up, we'll take the remaining $5,833. Okay? And we ultimately still stay at $5,000. Make sense? Many students think March 1st to the end of the year is 9 months because December is the 12th month and March is the 3rd month. No. March 1st, only 2 months have gone, if you think about it. So remember, March 1st, if we put something in service on March 1st, how many months do we have to depreciate it? March, April, May, June, July, August, September, October, November, December. It's 10 months. If we purchased it March 31st, it would be 9 months. Okay, so just don't mess that up. Okay? We never depreciate land unlike other long-term assets, land does not get used up. That is the only asset we do not depreciate. Okay, look at this one. How much depreciation should be recorded in the first year for a delivery truck purchased on April 1st with a cost of $30,000, an expected service life of 5 years, and an estimated residual value of $5,000? $5,000? What do you guys think? How many say A? Okay, how many say B? A it is. Oh, no, B it is. Why? 30,000 minus our 5,000, so that's 25,000. And, oh, April 1st. So we're only taking 9 months, right? Thank you, guys. So 9 months out of 12 months is $3,750. Now, it is common that, let's say we've got a delivery truck and we estimated its service life. We started it and said, oh, it's going to be 5 years. But in this case, assume that after 3 years, Little King Sandwiches estimates the remaining service life of the delivery truck to be 4 more years, for a total now service life of 7 years rather than the original 5. Little King also changes the estimated residual value to $3,000 from its original estimate of 5. When this happens, we don't go back and change anything from prior years. We just go from here forward. Okay? So, if this happens, we need to see what the book value is at the end of year 3. If we showed that at the end of year 3, the book value is sitting at 19, then we need to come up with our new residual value of 3, it tells us. And then from there, show how much we're going to depreciate. So we have 4 more years of depreciation. Won't we take $4,000 a year? Okay. I'm going to do activity-based real quick because it's just like straight line. Instead of using years, we use miles. Okay? So ignore the years, if we think this truck's going to last us for 100,000 miles, we figure out how many miles we went on it in this year, and that's what we take. So, if we estimate 35 cents a mile, we will then show if in year 1 the truck was driven 30,000 miles, we estimate 35 cents, and that's the depreciation we take. If in year 2 we drove 22,000 miles at 35 cents, that's the depreciation we take. Make sense? We do this until we hit 100,000 miles. But do you see how we don't ever go below the salvage value? Does that make sense? So, if, let's see if I can, okay, let me go back. So that is straightforward, just like straight line, except we use miles instead of years. Now, this double declining confuses many people, but guys, it doesn't have to be confusing. In your mind, know that straight line and activity-based are similar. They use a residual value, and you figure it based on the depreciable basis. Double declining is different. The way double declining works is we speed up depreciation. We make it a lot more in those beginning years. So, in the example of, let's say we depreciate something over 5 years. Isn't that usually 20% a year? Well, what we do with double declining is we double it. So if something's over 5 years and it should be 20%, we take 20% times 2 or 40% of it. And guys, we don't use the residual value. We don't take that into account when we do the double declining method. We take the book value times 40%. Or let's just say we were depreciating something over 4 years. Wouldn't that normal be 25% a year? But under double declining, you take 50%. Okay? So the way double declining works is you take the book value times double the rate, 40%. And do you see? In this case, that's $16,000 in the first year. Now here's the catch, guys. We show that accumulated depreciation in year 1 to be $16,000 and our new book value is $24,000. Do you see how in year 2 we're still going to take 40%, but we're going to take 40% of this $24,000? Does that make sense? So the new adjusted basis of the truck is $24,000 at the end of year 1. We're going to take $24,000 times 40%, okay? And this year it's $9,600. Okay? So at the end of 2 years, do you see we've already taken $25,600 in depreciation on a $40,000 truck? At the end of year 2, the book value is now sitting at $14,400. We're going to take 40% of that. But no, you never, ever, ever want to go below the residual value or the salvage value. Even though we don't take it into account when we determine depreciation, we don't want to go below that number. So do you see in year 5, our book value sitting at $51.84? We can only take $184 in depreciation that year, right? Because we can't go below $5,000, the salvage value. Make sense? When using the declining balance, mistakes are commonly made in the first and the last year. In the first year, students sometimes calculate depreciation incorrectly as cost minus residual value. You don't do that. You only take the cost times the depreciation rate. In the final year, some students incorrectly calculate depreciation in the same manner as in earlier years. But remember, you can't, because you can only go to where the salvage value hits. So you only take the amount to where you break even to the salvage value. Okay? Try this one, guys. What do you guys think? How many agree with C? Anybody else? So guys, let's just figure this out. What is normal depreciation for 6 years? Well, 1 divided by 6 is what? What percent? What? 16%. So double declining means 16 times 2%, right? 16 times 2, double, right? Is that right? So, okay, 1 divided by 6, let me just do this real quick. So 1 divided by 6 equal 1 divided by 6 is 16.6667. So this times 2 would be 33.33%, right? Does that make sense? So 33.33% of 30,000 is what? 10,000 bucks. Does that make sense? 33.33%. Now, no, under the straight line method, or the double declining, or the activity based, in the end, you're going to get the same results. It's just in between the years, you're going to get different numbers. Under the straight line, pure, flat, straight line, each year, same amount. Activity based, it's going to vary based on the number of miles, but it's the same amount per mile. Double declining is your tricky one. But guys, if you can distinguish with double declining that you do not use the residual value to calculate your depreciation, but you must be mindful of you can't go below that amount, you're going to be fine. And you know that after every year you adjust the new balance, adjusted book balance, and that percentage is against your adjusted book balance, okay? So do you see over time, we're going to depreciate the same amount. It's just with double declining, we depreciate a lot more earlier, and then we slow it down. Straight line is the flat amount every year, and activity based is going to vary on the activity. How are you guys doing? Most people use straight line. So I have students that say, then why do we have to know all the others? Because it's school. But most people use straight line. For tax depreciation, we usually use the accelerated methods because it just gives you more of a write-off in the earlier periods. Okay? Let's look at this Cherokee. Now, guys, I'm going to give you 5 minutes, but I want some of you, actually, let's all do double declining, okay? We'll do the straight line and the activity base together, but I want you guys to try double declining on your own because that's the trickiest, okay? Cherokee purchased a new copy machine that cost $140,000, including installation. The company estimates the equipment will have a residual value of $35,000. Cherokee Copy also estimates it will use the machine for 4 years or 8,000 total hours. Prepare a depreciation schedule for 4 years using the following method. Try double declining. Okay? Got it? Remember, you cannot go under $35,000 in year 4. you guys done? What do you have? Anyone tell me what's in year one? 70,000? How many have 70,000 in year one? Okay, year two? So 70,000 year one. Year two, 35. Awesome. Year three, nothing. And year four, nothing, because you cannot go below the 35,000, right? Does that make sense, guys? Guys, that is the hardest method. Okay? If you remember those two concepts, that you double the percentage and that you adjust your basis each year and only use that doubled percentage on the adjusted basis, and you cannot go below the residual value, you're going to be fine. Using straight line, we take 105,000, the cost minus the salvage value, and we multiply that times the number of years. It's the same amount each year. And activity-based is per miles or hours, right? And they tell you how many hours, 9,000 hours. You come up with a rate per hour of $13.125. Does that make sense, guys? Now, unlike tangible assets, when we amortize is what we call the depreciation of intangible assets, we amortize it. When we amortize intangible assets, we don't worry about a contra account. We amortize or allocate a portion of its remaining useful life, and we call it amortization. And we use the straight line method. So when Little King Sandwiches acquires franchise rights for $800,000, and it's for a period of 20 years. It also acquires a patent for $72,000, where there are 12 years remaining on the patent. How do we record this? The $800,000 divided by 20 years. So that would be $40,000 a year. Do you guys see we don't use an accumulated amortization? We just credit the franchise. And with patents, we just credit the patent. This is different from how we do tangible assets, isn't it? With tangible assets, we use an accumulated depreciation. We don't with intangibles. And we do them all straight line. Know that we amortize patents, copyrights, trademarks with finite lives. If they've got an infinite life, and most do, you renew them every 10 years. And franchises. What we don't ever amortize are trademarks with infinite lives, which most have them, and goodwill. So we need to talk about this goodwill, okay? Which of the following intangible assets would not be subject to amortization? B. Good. So, goodwill, we're going to talk about how we determine if it's being overvalued in a minute. What happens when we've used up an asset, we've depreciated it, and we get rid of it? Now, we can get rid of it in three manners. One is by selling it, one is by retiring it, or one is by exchanging it. So, when we sell it, we will have a sales price. When we retire it, there will be no sales price. We're just taking it out of commission. And then in exchange, we've got a couple more pieces to the equation there. So three methods of disposing an asset, selling it, retiring it, or exchanging it. Most people sell assets. Okay? Retiring occurs when a long-term asset isn't even useful and it can't be sold. And exchanging are when two companies trade long-term assets. So, remember, when we do this, we're going to have to update our depreciation prior to disposing of it. Okay? So we have to make sure we know what depreciation we've taken, and we need to update it prior to the disposal. And we need to know exactly how much depreciation we've taken on this asset over its useful life. So when we show the sale or retirement or exchange, we have the correct amount we've taken. Here we know that we have a truck. We purchased it for $40,000. The residual value is 5. Its estimated service life is 5 years. And if we're doing straight line depreciation, we're doing 7 a year. Little King sells the truck at the end of year 3 for $22,000. Think about it, guys. If we've taken $7,000 of depreciation a year, isn't that $21,000 in depreciation we've taken at the end of year 3? We need to be aware of that because we're going to show we received $22,000 of cash. We're going to show that we've taken the equipment of $21,000. We've taken that accumulated depreciation of $21,000. We need to zero that out. We need to show what we purchased that equipment for to get it off our books of $40,000. And then we're going to either have a gain or a loss. In this case, we have a $1,000 gain. We showed on our books, $3,000 gain, duh. We showed $40,000 minus the accumulated depreciation of 21 means our adjusted basis is how much? 19, right? And if we sold it for 22, doesn't that mean we have a $3,000 gain? We have to zero out the equipment and we have to zero out our accumulated depreciation when we get rid of an asset. Okay? Make sense? Now, what if Little King sells the truck at the end of year 3 for $17,000, not 22, but 17. Wouldn't we show the same thing? We would show on the books, the cash is different. The cash is $17,000. We'll zero out our accumulated depreciation since it's normally accumulated depreciation is a credit account. We debit it to zero it out. Our equipment is normally a debit balance. We're going to credit it to zero it out. And if our adjusted basis in this truck is 40 minus 21 or 19, and we're selling it for 17, isn't that a loss? We're selling it for less than what our basis is. What if we just retire this truck at the end of year 3? Well, there's no cash, okay? All it is zeroing out the truck, zeroing out the accumulated depreciation, and in this case, we would show a loss of $19,000. Make sense? Jacoby Landscaping sold lawn equipment for $7,000. The equipment was originally purchased for $20,000, and depreciation through the date of sale totaled $15,000. What's the amount of the gain or loss? Do you see how we know it was a $2,000 gain? The purchase price of 20 minus our accumulated depreciation of 15 gives us a basis of 5,000. If we sold it for 7, isn't that a $2,000 gain? Make sense? Now, when we do exchanges, we have a trade-in allowance. The trade-in of the allowance is the new truck is going to be equal to the 45,000 less the 22,000 we paid in cash. So, if our new truck, we have the original cost of the truck of 40, we've got accumulated depreciation of 21, so here we have an adjusted basis of 19. If, we received cash of 22,000, the new truck of 45 less the 22,000 paid gives us a trade-in allowance of 23,000 here. Sorry, guys. So, you see the equipment, the new truck is 45,000. The accumulated depreciation we took on the old truck is 21. We zero that out. We zero out the equipment. We show the cash we paid to show, in this case, a gain of 4,000. Okay? Remember, if we dispose of an asset for more than its book value, it's going to be a gain. And if we dispose of an asset for less than its book value, it's going to be a loss. I just don't have time to go through that, but feel free to look at this exercise in the PowerPoint of showing us some sales. Last, return on assets, I'm going to let you look at these various ratios. And the last piece I want to talk about is goodwill and impairment of long-term assets. So basically, when impairment occurs is, generally speaking, when we're dealing with especially goodwill, impairment occurs when the expected future cash flows generated for a long-term asset fall below its book value. So basically, our future cash flows less than the book value we have on the book. If they're not, there's no impairment, there's nothing you need to do. But if the future generated expected cash flows are going to be less than the book value, then we need to adjust the asset. Goodwill primarily is what we test for impairment. If the asset is impaired, meaning that the expected future cash flows are greater than its book value, we then need to go on to step 2 to see, do we need to record a loss? We will record a loss if the book value of assets minus the fair value of the asset. So we won't necessarily show, step 1 allows us to determine if there's an impairment. Then the loss we will show is equal to the book value of the asset minus the fair value of the asset. That is what we will record for the loss. Little King's trademark has a book value of $50,000, estimated future cash flows of $20,000, and an estimated fair value of $12,000. Step 1, we test for impairment. Are the estimated future cash flows less than the book value? Well, they're telling us the estimated future cash flows are at 20. The book value is at 50. So yes, it is impaired. If it is impaired, then we go to step 2. What we do is record the loss. If the book value is at 50 and the fair value is at 12, we have to write down the loss to be the true fair value of the asset. So we will show a loss on our books of $38,000 and reduce that asset that trademark down to its fair value. So we would credit the trademark account $38,000. So we show the true fair value now is at 12. Does that make sense? So no, guys, when you test for impairment, it's a two-step process. The first step is, are expected future cash flows greater than what we're showing on the books? If it is, then we have to record the loss. Okay? Again, here's another one for you to look at. Let me just finish up with, let's see here. Number 5 is going to be, you're going to need to do depreciation using those 3 methods. So we went over that. You should be fine there. And then you're going to have to do some amortization, recording allocation of intangibles in number 8. Then on this one, you're going to have to do depreciation again on number 9. Anyway, guys, I know I'm behind here. I apologize. New Morning Bakery, I think we just did that one. If you have questions, please use the discussion board to go over them. Okay? Have a great day, guys.